welcome everybody to our webinar on artificial intelligence. It is the first webinar in the series of continuing education webinars, which is supported by the huge organization USAID Financial Sector Transformation Project. So we are very happy to have not only the huge organization, but actually an organization who's sharing our values. And we decided to start our series with one of the most exciting topics, which is artificial intelligence. No doubt that the companies who are targeted to implement the artificial intelligence will definitely have the competitive advantage in the nearest future. So we invited Larry Kao, Director of Research from CFA Institute, to share the results of one of the, I think, most interesting researchers from CFA Institute, like artificial intelligence pioneers and investment managers. So please welcome Larry Kao with his presentation.
Well, thank you, Anna. So people can see me. I'll show this report. So this is the report that we're basing this work on. So we have prepared a PowerPoint, so we'll go through that for hopefully half an hour, 45 minutes. So do please ask questions along the way, and we'll reserve some time in the end for additional questions as well. But you ask questions along the way, it helps me get a sense of what topics you're interested in, so we can talk more about that. So with that, let's get started. So if you see the chat button, you can use that to ask questions. And in the end, if you ask questions, you can ask them using the mic as well. So let's get started. So I hope everybody can see the screen. If you cannot, please raise your hand or send me a message. So artificial intelligence obviously is a very hot topic, right? So today we're going to talk about three different topics. Number one is from a technology point of view, what can AI and big data do? You know, what are the capabilities already? And two is how is this getting into investment? And what should we as the investment professionals do? You know, as a sort of a response, right? Because a lot of people see AI and big data as a threat. You know, is it truly a threat, or should we really work with AI and big data, embrace that technology, right? So that is the second section. And then lastly, the third section, we're going to talk about some of the best practices in applying big data and AI in investments, right? In preparing for this report, we talked to investment professionals on 3 continents. We also talked to people from all 4 lines of business, right? Equity, bonds, asset allocation, and hedge funds. So it's a 3x4 matrix, and we picked some interesting cases from that matrix to share with you. So this presentation is really based on a number of our past research reports. We started publishing our FinTech research in 2017. So there was then there was FinTech 2018. You may have heard of this other report that came out last year as well, Investment Professional of the Future, where we talk about how investment professionals should respond to the development in technology. And lastly, this is mostly based on this last report that came out last September, October. It's called AI Pioneers in Investment Management. You can find this online. All 4 reports are available free to download online from our website. So number one, the first topic, what can AI and big data do? So AI became a popular topic basically together with AlphaGo. And then you can see this from Google Trends, right? So AI became a topic right around then, and it peaked about a few years later. So it peaked in about early 2018. And over the last couple of years, it's actually come down a little. So this is a very typical hype cycle if you follow Gartner's work, right? There's always this interest, development, then people think a lot of it, and so the peak cycle reached the top. And once people started to think about doing something with it, they realize it's not as easy, so it normally comes down a bit. So actually it's a positive sign, we think, that this hype cycle has actually is coming down, because that indicates really people are looking to implement this. So this is a summary that we put together. You know, we look at all these cases. We think that the simple way to put this is AI and big data enable human beings to do two things. One is to process new data, so data that we did not have access to or we could not process. The other one is really process data in new ways. So this could be new data, could be existing data, but it's just ways we didn't know how to do, to process data. So these are the two main sort of aspects of this AI and big data. Is really one is new data, one is new ways to process data. So to really break this down, what is AI and big data? What are some of the developments? So the first area is typically what we call NLP, computer vision, and voice recognition. So these are, as you can see, are basically sort of a cognitive abilities, right? It's basically NLP stands for natural language processing. It's basically a computer program that help you understand text messages, text content, right? Anything that's written in words. And computer vision processes images, and voice recognition processes spoken languages. So both, all three types of information were difficult to process before. So computer vision really started early. You look back at the development over the last few years. Really, in 2017, the AI programs have already beaten human beings, an average human being, in understanding images. So they can see in the picture what kind of a tropical bird it is, right? For example. NLP, I think this is started in January 2018. There were two AI programs. They announced sort of days apart that they were able to actually read better than an average human being. So it means once they process some text information, they get more information out of that than an average human being. And then machine learning, so this is another aspect. Lastly, voice recognition. So voice recognition also in 2018, they said, oh, this is actually the computer programs now can understand spoken languages better than an average human being as well. So what are these things that we're talking about, right? I think big data, really there are two terms for it. One is called alternative data, one is called unstructured data. So NLP, computer vision, and voice recognition, all these types of programs, what they process is basically what technologists would call alternative data, right? Or unstructured data, meaning it wasn't digitized. So it used to be called digitization. So now they basically call, they basically process these unstructured data. Alternative data is a term that's used more often used by finance professionals, right? To us, this is type of data basically that's not mainstream, so it's alternative. To a technologist, these are basically not structured, so they're called unstructured data. So there's a lot of overlap, but they're not always identical. They're typically just used by different people to mean something that's very similar, but not always the same. And then the last one is machine learning, right? So we talk about these cognitive abilities, we talk about this big data, and then the last one is really machine learning. So these are the three areas where people are, think about when they think about artificial intelligence. So machine learning is just one subfield of artificial intelligence, right? Artificial intelligence is very broad. It's also a very fluid concept. Now sort of machine learning has become very popular, but it wasn't popular for many decades, right? I think it's became popular recently, partly because of AlphaGo and similar programs, because they've had a lot of success. And people say, oh, this actually can work. So it's basically a machine learning, meaning the AI programs can learn on their own. So you program them to learn on their own instead of feeding them these algorithms. They can develop their own algorithm as they get new data. So deep learning is another subfield within machine learning. So you probably hear the term a lot as well. Deep learning simply means sort of very sophisticated machine learning in a way, but in a particular direction. So we skip the concept in between machine learning and deep learning, which is usually called neural networks. So this has been around for a long time, and a lot of finance people used to practice that as well. Deep learning is just a very complicated neural networks. And this is what we meant when we said new ways to process data. Because typically how we process data has always been using sort of these linear algebra, right? These things have been around for many hundreds of years, and we haven't had made a lot of progress from there. I think machine learning and deep learning, these neural networks basically allows you to get some of these non-linear relationships. They also do not have to be specifically defined. You know what you throw into these programs, and you get an output. You don't necessarily know how they actually iterate, through each step of the networks. You don't know how they find the connections, which is allows a lot more new possibilities. So in summary, this is kind of the benefits of AI and big data. So we talk about new data and new ways to process data. So for investors, this new data is more relevant for analysts, for them to analyze companies and industries, etc. And new ways to process data is often more applicable for quant PMs in particular. So you make more informed decisions, right? So you get better results. So if you further break this down, there are 3 types of applications that we're going to talk about in the 3rd section. So the first one is what we just talked about, this cognitive abilities. And the second one is big data. So these all fall in under this new data aspect. So I think the difference between these 2 types is big data doesn't have to rely on AI necessarily. And we'll give an example in the end as well. But type 1, they always need data to process to have impact. But they specifically themselves refer to these AI techniques. So the last one, machine learning, deep learning, this is basically, as we said, new ways to process data. So they don't have to be like matrix algebra, so they operate differently. So before we get into the cases in the last section, I want to give a couple of really quick cases and see how these things actually are having an impact in finance already. So all this AI and big data, all these developments, are they really changing finance already? There are examples that says they are. Obviously not everywhere. So look at this case on the right-hand side, health screening. So John Hancock is one of the largest life insurance companies in the U.S., and they decided to sell life insurance only to people with wearable devices, right? So they said they look at their own pool, and they found that people with wearable devices compared to those without often can live many years longer. So the life expectancy is somewhere between more than a dozen years longer for people with wearable devices, right? This does not have to be a causal relationship. This is just one relationship they identified. So as a life insurer, you can imagine how much impact this would have on their bottom line. This is basically saying you can hold on to the insurance premiums from these policyholders more than a dozen years longer than your competitors. So it's a huge deal. The next one, we'll talk about an example on the left-hand side. This is a Zhong'an Insurance. We talk about intelligent pricing. So ZhongAn Insurance is an online insurance company started by the three very profound businessmen, very well-known businessmen in China. They basically started Alibaba, they started Tencent, and they started Ping An Insurance. So the three founders got together and started this online insurance. And what they do with auto pricing, for example, with auto insurance, is they would get data on the driver, so they know when you drive, where you drive, and if you step on the gas too fast, if you step on the brakes too slow, and all these different data about you, and they use that data to accurately price every individual's risk from an auto auto insurance perspective. So with that individualized data, they could have this pricing obviously more accurate than someone who basically prices an overall pool. Because if your risk is higher than the pool, before this technology, they can only price you at the average of the pool, which means you're a higher risk to them. You're a higher risk to them. You'll be gladly buying their policy, but they probably lose money. So now they can tell if you're a higher risk, they'll raise prices on you. You may go buy their competitors' insurance, so the competitor will lose money. And if you are a lower risk, you wouldn't buy the competitor's insurance, you will buy their insurance, so their competitors would lose business. So either way, longer term, if you look at this from a long-term perspective, they would have a huge edge versus their competition who do not have this process and technology in place. If these technologies are so powerful, you would ask, how many people are using them in investments already? So we did this survey at the beginning of 2019 together with our practice analysis team, right? So we did the survey of a few hundred CFA charter holders all around the world. So I think the survey was sent to a few thousand people. We got about 700 responses. And this is kind of the result. Of the 230 PMs who responded, the options below describe their process. We asked them whether they use different technologies together, and this is sort of the result. So if you look at the report, in the report, we actually showed a chart that says 10% of them use machine learning in their process. What about the analyst side? So this is the analyst side, and a small number of analysts, 159 of them around the world, responded to this. And you can see the percentage of them also already using machine learning was also very low. So why is that? So that's kind of what we're going to talk about in the second section. So since this technology is very powerful, why aren't we already using it? So these are our early views on fintech in general. We thought basically fintech actually is not powerful in everything. It's actually mostly powerful in places that are where financial services are underrepresented. So basically, where places financial services is not very developed. But I think the second important thing is the point we want to make here for this presentation is we think collaboration is the key for finance and technology to make fintech work. And then this is our more recent view on fintech. The first slide came out of our FinTech 2017 report. This one came out of the 2018 report. We said, after we said this whole thing needs collaboration, we thought the early stage fintech, they may not transform financial services, but AI, big data, and cloud computing, etc., what people call the ABCD, the fintech, these would most likely transform financial services as we know it. And more importantly, at this stage of fintech development, there's a more urgent need for us to actually for us to engage in collaboration between fin and tech. And this is a report where we started to see these collaborations taking place 6 months after we first wrote about it, and then we actually interviewed with the news media to discuss some of the cases. So this is the FinTech pyramid. This actually is our attempt to answer that question. So since AI and big data are so powerful, why aren't everybody, why isn't everybody already using it? So we think this is the FinTech pyramid, right? Everybody wants to get to the top, but these are hurdles that prevents you from getting to the top. Number one, the challenge is cost. These things tend to be very costly, and so it takes a long time for them to become, you have to spend a lot of money before you can see impact. So that is one reason why this hasn't actually been more frequently used. Costs a lot of money. It generally costs more money than you would think. And the second one is talent. There are just not that many people that are trained in these skills, right? We're not only talking about schools not producing enough AI and big data graduates, we're also talking about there are mostly, and more importantly, I think we're talking about there are not enough people in the business that are actually have practical experience in operating these AI and big data schemes, right? So I think it's we think the a degree is not enough in these businesses. People want they need to have hands-on experiences, and you typically only get that experience at some of the top technology companies around the world. And the people at these top technology companies engaged in these AI and big data area are actually not that many. And even fewer of them would actually get into finance. So we're not seeing a lot of these talents in investments. And then technology. I think technology is obvious because AI and big data is sort of developing very quickly. Even you were the best technologist, you may not know what's going on, right? We've seen people who are who teaches these science at different schools, and they may not actually know the latest development. So I think this is very important for any particular firm, is the vision, right? Is management need to have that vision and understands what AI and big data can do for the industry, for his firm, and for their clients. This is sort of an area that actually takes a lot of guts on the management from the management perspective as well, because there are so few examples ahead of you. So you'll have to invest in something new, spend a lot of money, and the outcome is not always certain. It's not easy to get, there's no guarantee that you'll get positive results. So this is a sort of a demand on management really to take action, and that's challenging. And the last one is really time, because no one can bypass this because this is so new and there are no textbooks out there to learn how to do this. So you have to actually learn a lot on your own. And the time it takes to make any small incremental progress is also often beyond our imaginations. We talk to a lot of people, seemingly very minor progress, very minor enhancement to the investment process takes a long time. So how do you tackle that? And this is the part that we talk about, how do we respond? Is we think the best response is not necessarily for all of us as investment professionals to start learning AI and big data. It doesn't mean we shouldn't. It just doesn't, it means we shouldn't count on ourselves to become the best AI and big data specialists. So there are always better AI and big data specialists out there, these technologists, right? So the future investment teams, we think, will not only have an investment function, but will also have a technology function and we call it the T-shaped team, right? Basically an extension of the T-shaped skills concept. So T-shaped team, meaning one is investment and technology are basically very different lines of work. And people don't understand each other. They're perpendicular in math terms, right? So this is why it looks like that. And two, we wanted to show this is basically an extension of that T-shaped skills concept. It's sort of a, we need to put all these different skills together. And to make this T-shaped team work, we added a third function, this function we called innovation, for lack of a better name. Really, their role is to help investment and technology functions integrate to achieve desired results. Because we're so different, we think differently, we act differently, we don't understand each other. We need a group. We need this group who understand both sides and can make sure that we can work together and generate desired results. So that's sort of the innovation team. And we have roles on the right-hand side that you can look at. So what is the future? The future is that is man versus machine, or is that the man plus machine, right? From our previous discussions, you probably have already guessed our response. We think this response will be, the winners will be basically people in this blue quadrant. This will be a team that are strong in AI, but also strong in human intelligence. And so those are in the gray zone are probably going to lose out. And those in the different color red zones will have to find ways to get into the blue zone to be long-term winners. So the cases in the next section will hopefully give people some idea why this is the case. So we have prepared a few cases that are sort of relevant for our discussion, I guess. So as we said, we look for best practices across the 3 continents and 4 business lines. And this particular example, the company is obviously headquartered in Europe. And this is an application mostly that applies to the equity business. So this is for like a full-blown application of AI and big data across different teams within an investment firm. So this is that kind of an example. So if you are a large enough firm who can afford to have your own technology teams, etc., and you want to apply it across different investment teams, this will be the way to do it. So I think that's sort of what the case is all about. So we got a question, and I'm happy to address that before we go further. So the question says, in your opinion, a future specialist should firstly get knowledge in tech area or fin area? I don't think there's a either or. I guess depending on where you are in your career, you probably already have fin or tech, right? I think mostly our CFA charter holders are finance professionals already. So with that in mind, I think we should work with technologists. We need to train ourselves in these business areas, but since it may take us longer to become the top specialists, right? It's impossible. A very small segment of the population can be good at both. Most of us cannot be. So the best way for us to do this is to partner with someone. In practice, we've seen more technology folks get into finance. So in a way, you can say there are a lot of people who get knowledge in the tech area first and then get into finance. You see less people who get CFA charter holders and then take a technology degree or get technology training. But it doesn't mean it's impossible. So we do see finance folks who want to get trained in technology from time to time as well. So in practice, I guess it happens the other way around more. But I think the most important takeaway really is, even we can do this on our own, we should try to work with the best in technology, Because just imagine, right? We spent many years to get to try to become a better investor. And those folks with training in technology, they would have spent many years in technology to become the best in their business. So the chance of us becoming the best in their business is a lot lower than the chance of us becoming the best in the investment business. So that's kind of our responsive is really just to that's a kind of our response is really to try to become the best in our business and work with the best in the technology business. So that's kind of the situation. Okay, so with that we'll go back to our SCHRODERS example. So this is they were one of the earlier ones, right? They formed the data insights unit actually in 2014. This is well before actually AI and big data became a sort of a everyday topic for most people. So I think that's sort of a very early start, and they did get an edge, right, in this data-led research, and they're trying to have this different insights. So I think this is interesting is how they build the data science team, right? So we wrote about this innovation team concept around December 2018, and then we did this whole AI research, I think, in the spring of 2019. But we were very happy to find all these innovation teams at different firms, right? So we thought this is required. And as we see sort of successful cases, they do have these people in place. So they sit in different places, right? In SCHRODERS example, we think the heads of the investment team and the heads of the technology team, they actually played that role of the innovation team. The two of them are friends. The business guy introduced the technology guy to come to their firm to start this whole operation. So they collaborate well, so they became that link between the two teams, right? So this is how it started. So the first panel, you see that they basically started searching for help searching companies to invest, use NLP algorithm to analyze articles and then to find interesting ideas. And then they applied different AIs or machine learning techniques in this process. The important thing really is the choice of these different areas. Where do you begin to enhance the investment process is jointly made by both sides, right? So have the data engineers and the investment people and the sort of the thought leaders on both sides, they together agree on where to tackle, where to begin, and then what do we do next. So this is kind of an investment process. And this is what I was referring to just now, is how do you actually start building this team, is the portfolio manager, Ben, actually brought one of his friends, Mark, who's a data scientist, to the team. And once they see early results, they started building out this data scientist team with consultants, with data engineers. And so this is kind of very actually similar to what we envisioned in that previous T-shaped team chart. If you look back at the roles we suggested having, this is exactly actually how it played out. They obviously did all this years ago before we knew it, but we kind of were suggesting things along the same path. And then once they have the team in place, they basically, the first important product they had was to analyze articles with AI and then suggest investment ideas to the investment team. So this is just one of their projects. So I think the key takeaways the SCHRODERS team shared with us, they said it's really important to have a senior sponsor who understands this. So this basically goes back to the management vision concept we talk about in the FinTech pyramid. And also they said to have the right mix of skills within the team. So this is the T-shaped team, a T-shaped team concept that we talk about, right? So the second panel, I think that's also a very important takeaway. It's not AI for the purpose of AI. You want to do AI and big data in investments because you think they can add value. So the value needs to be appreciated by the investment team. That's why the projects are jointly taken by the investment team and the technology team. You just can't say, oh, this does a good job. Well, you guys take this, right? The investment managers, ourselves, would naturally have this doubts and resistance to new technology, right? It's the threat to how we do business. And we'll tell you it doesn't, but there's always that doubt. So I think working together is being very transparent is always very important. The last one is they said make the team a centralized function available to all investors. This is just a very practical advice. So I think for most firms, you may not be able to afford having a specialist team for each investment team. You can't have a technology team for each investment team. So in that, under that circumstance, you basically will have to pool the technology resources. So the technology team works for all investment team and it's not dedicated. I would imagine, say, give it a 10, 20 years, we may get to a point where each investment team will have an embedded technology team, but obviously nobody's there yet. So that is the case that I find very interesting. They started early, they've seen a lot of results. So they have this dedicated technology team now, data science unit, insights unit, and they actually have tackled a lot of problems over the last 5 or 6 years. So the one answer now is there is a trend to outsource all the tech stuff to software providers and focus on the business part. Will investment companies outsource AI and machine learning to third party as well, or will they build their own AI and machine learning teams? Will there be a future for AI and machine learning outsource providers? Very much so. So if you actually look at the report, there is a case. So if you flip over to the content page, there is a case that's case number 6 in this report. Actually is a case that they use an outsourced provider. So this is the largest investment management firm in China. Even then, they didn't think they would be able to build this on their own. They actually work with a third-party provider. So this does happen a lot. I think this would happen particularly in the case of medium-sized, small-sized investment firms, because I think only the large firms can have enough resources to build their own dedicated team, probably, and this becomes their advantage. The risk of working with a third-party vendor, you outsource this, is always the trust issue, because you want this to be a dedicated solution for you. You will have to share with them your investment insights to build these algorithms. But once they build it, their incentive would be to sell this to everybody else, right? I think you can, your contract will have to reflect that fact that you want to own this. But if you want to own this, I think the price, the sticker, it will probably go up. So there's always pros and cons to doing it in-house and outsource. I think the successful cases we have seen so far mostly are with large firms, probably for that reason, because you need the resource. And they outsource a lot of the specific technology to third party. They can't really build everything off the ground on their own. They outsource the basic, say, programming, sometimes to third party. They use software packages of third parties. So this is all fine, but the actual algorithm you would want to do on your own. The data, a lot of times, you even want to have it proprietary if you can. So different ways to look at this, right? So this is sort of the general prospect. I hope that answered your question. If not, do please ask a follow-up question. So I think in general, to repeat, I think large firms would prefer to do this in-house. But for the majority of the medium-sized and small-sized investment firms, they are likely not be able to actually do this in-house. They would want to actually partner with someone. Even then, you will need people in-house who understands what's being done, who helps plan these. So you need basically a technology team leader sort of person on the inside. So you need basically a scaled down technology team. If you completely trust this to third parties, no one is responsible for how the technology develops, that roadmap in your own firm. That will be a big issue. You would basically want to map out for the next 5, 10, 20 years how your firm would want to develop along this fin plus tech, this collaboration approach. And someone needs to be responsible for the tech part within your own firm, so the business and the tech side can collaborate to develop all these different things together. So the next case is a machine learning application. So this is also a smaller scale application. So this is basically a smaller team within a large investment firm, but they basically, they don't tackle the whole firm's problem. They tackle basically asset allocation problems. In New York Life Investment, obviously they're based in New York, they're headquartered in New York. And the focus of this application is asset allocation. So they run about $10 billion in global macro. So this is where out of the whole 300 billion of the entire firm. So this is kind of the background of this application. So look at this model, right? The 4 blocks in red: cycle, momentum, sentiment, and value. These are the basic kind of the pillars within their quant model. So these are risk factors. They probably use them to generate, for their alpha models as well. So, and under each area, there are different models, right? So you look at the next level, the 3 circles, that explains how this works, right? How they add machine learning components to it. So each of these 4 areas would have a few indicators. So before, this was all done with linear programs, etc. Now with machine learning, they basically feed these market drivers, things that they think will impact investment results, what technologists would call features, into these models. And then machine learning program would analyze all these different features, and then they will actually spit out their interpretation. For example, I think many of us would appreciate the fact that in different stages of the cycle, you would invest differently. But how do you determine what stage of the cycle are we in? So this is one of the questions they use machine learning to help answer. So they basically throw in all the features they think that are relevant, and machine learning program will spit out and result. So this is how they use this a process to enhance their investments. So basically, it's a quant model with 4 aspects of some 20 factors probably, and they use this machine learning process on a number of these factors. And we just explained one related to the cycle, but it's more than that, right? So but it's just a few factors, though. It's not all the factors. So this is just one way of them actually improving their process. So this is sort of their takeaway. They said, well, now we use machine learning, we can process a lot more data and improve results and identify the most important predictors, because there are a lot of factors, you don't know which ones work. And with this, they have a better sense what factors are at work at each point in time, so they can they have a better understanding of where they are in the cycle. So that's what they said, is focus on the most important indicators. So this is why we said this whole new ways of looking at data is really helpful for PMs, because they get more insights out of these data that are very relevant for portfolio construction because of these new insights, right? So this is kind of that particular example. Okay, so this is a question that we can answer now. So regarding slide 29, the US asset manager is there research on how the application of AI machine learning can generate a positive alpha regarding the market indices? So this is a sort of this particular case is general, right? So this is asset allocation. They look at, for example, they look at where they are in the cycle, then they decide their allocation. They do stock or bonds. They do what kind of stocks and what kind of bonds, right? Because if it's late cycle, you get more defensive. Early cycle, you get more aggressive. So that's what this is talking about. So the benchmark is not necessarily S&P 500, but it would be sort of the it could be a blended benchmark, right? And the market indices, it's some blended market indices. So is there research on how you do this? And this is why we said this whole thing takes more time and you need talent, as hurdles, because there are no textbooks out there, right? All these people, we call them pioneers, because that's what they really are, because they have to figure out all these things on their own, and it would take longer. And that's why it takes a lot of investments, takes a lot of commitment on the management side. We are thinking of publishing a AI and the big data handbook, though, which is not something we have embarked on. We're considering doing a project that answers exactly this type of questions. We don't have all the answers, but down the road, I think when we do have more of the answers, we would consider publishing a volume, a report that specifically addresses some of these questions. And we do have a literature review coming out from the Research Foundation that basically goes back a few years, I guess, summarizes all the important academic research published in this area. What can AI and big data do in investments? So that will be an interesting piece for many people in the meantime. Another question that came in is there an example of applying AI and machine learning for other than PM area and risk analysis, like finance reporting and accounting? There are. It's just that was not the focus of this report, but we actually believe AI applications will be even more, we'll actually see more impact in reporting and accounting, all these more routine and sort of repetitive type of tasks. So I think we'll see that happen first before they have a more profound impact in the investments. It just wasn't the focus of our research. So Goldman Sachs, this is a case of using big data alone. So this is actually using big data without AI, which is fairly interesting. And they have this obviously in-house team, but this is a sell-side example. So it's actually interesting from that perspective as well. So the question they were trying to answer were very difficult for a fundamental analyst alone to be able to find a solution. So they basically wanted to find answers to the question is how do you assess the market power of 3 US aggregates makers, right? They're people that make aggregates, and aggregates is basically rocks mixed with cement, used in construction. So you need to mix these things before you build a building. But then the rocks and cement, because they need rocks, so all these aggregate factories need to be close to quarries where you get the rocks. But because of the cement, they had to mix it to sell it. Basically all these the factories are close to the construction sites, meaning they basically cannot sell probably beyond a 25-mile circle. So each of these publicly listed companies would have hundreds of these factories around the country. They're US companies. So how do you compare the market power of these 3 companies? So you need to compare in each locale, in each market at 25-mile radius, who's selling more, who's selling less. How do you get all that information, right? This is just an impossible task for a fundamental analyst to tackle otherwise. But they worked with their data scientists, and they came to this solution, which is very smart in many ways between the two of them. So they basically work with the data scientists to find new data and process them. So the new data are the two red circles in the middle. So one, there is a geospatial library each of these quarries of all these companies are. So you can put them on the map, and you can put them, you can draw a 25-mile radius around these quarries, and you'd see basically where they are and their markets. And if there are lots of quarries in that 125-mile radius, they would obviously split the market. So how do you determine the market share? Then they found another data set, which is what they call the quarry-specific metadata. It's basically the US Labor Bureau publishes this. They would publish for each quarry how many people are working there and the hours they worked. So you can basically use that as approximation of the output. So you basically can now draw a map and find all these companies, and then using that labor data as output to understand the market share in each market, in each local market. And then you can aggregate that across the country for each of the three companies. And then you can see their market share, and that's their market power. So a very elegant solution, actually, that did not require them to go out and buy any data. So all these data were publicly available. So it looks like they saved money. So they actually did not need to spend a lot of money, not on the cost hurdle in that fintech pyramid, but I would imagine the cost is reflected in talents, because you need smart people to come up with smart solutions like this. So this is kind of the process that's shown on this chart. So the takeaways are very interesting as well. Is basically, number one, you don't underestimate what these things can do, right? I think a lot of time fundamental analysts say, oh, what can you do for me? So there's actually a lot that can be done that are not otherwise possible. Two, I think this is shared before as well, is alternative data adds to the mosaic, but it's not a goal in and of itself. So again, this is sort of we're not doing AI and big data for AI and big data purpose. So we want to drive investment results. And then say these niche sector-specific data sets are basically more helpful for fundamental analysts. So big data in general, I think, is of that nature. And the last one, I think there was a little bit of a show off. Is you don't always necessarily to break the bank to do data, to do big data. That's true, but you have to be smart, and it's actually not easy to always find these solutions that you can do things inexpensively. So spending money, everybody can. To do things effectively without spending a lot of money, it requires a lot of smarts. So looks like we have more questions coming in. Let me take a look. What are the most popular instruments and apps used for AI and machine learning analysis? R, Python, or any other? I think indeed the most popular ones we hear are R and Python. So these are the programming languages that use more. And each of them has some of their own packages that you can use in AI and in machine learning. So that is that. I think there's a question I want to answer now because we're getting to the end. Is in terms of valuation of AI startup, what factors would you consider to forecast its revenues? Not specifically the focus of this report, but I would venture an answer based on our experience. I think this is one very interesting answer we get from conversations with AI startups. Is they said that it's very difficult to get this right in one step. You have to basically do them in many iterations because this is so complicated. So this is a little bit of like related to our fintech pyramid, right? This is kind of the challenge. The pyramid basically says it takes so much to get it right, and in reality, you see people complaining that they cannot get it right in one iteration. So I think the if you value the startup, I think obviously you have to see you do the typical thing: is addressable market, what is the chance of them getting a piece of that market, and to analyze that, to get answers to these questions. I think you'll want to look at their team, right? The T-shaped structure. Do they have people that understand the business? Do they have people that have the technical competence? I think to me, that has been the most important one. So we did cover one startup in this report, which is the one I mentioned, the one that provides a solution to the largest investment manager in China. I think they actually got this right internally. So they basically provided this credit management solution to analyze the bond markets. In China, they use all these AI technologies, so they have a good data science team, but also the data engineers, etc. So this technology team is well done. But they also have people who understand the credit side of the business, people coming from Moody's, coming from other credit rating agencies, from other banks, etc. So I think and these teams work together. They actually had this innovation team in place. I think they call it the strategy department or something. So and that's how they kind of were actually be able to get results that even the largest asset manager in China found value. It's because they set up the team properly. So really, you need to look at how they tackle all these different issues on the fintech pyramid, and whether they have the right team in place. With that, I think you can get a sense of the addressable market and what is the chance of them getting a piece of that market. Another question says, what should be the focus of fintech software providers if they want to develop AI and machine learning solutions? Not the focus of our report again, but I think we addressed that a little bit just now as well. It basically, you don't want to become the old fintech companies, right? The fintech actually means something very different from financial technology. I would argue the people that got hurt most by fintech is actually those financial technology companies, because they hold on to the old technology, which is being abandoned by banks. And the new breed of investment firms are going to embrace a new breed of technology. So I think it's, as a software company, you obviously need to do the right thing in terms of the ABCD, the fintech, right? Your technology, infrastructure, etc. But also importantly, like we said, you need people within your firm that understands the business of your addressable market. The other question we just got is, in which areas of AI and machine learning do you think the portfolio manager should get expertise first? This is the question that we wanted to address in the handbook as well, because I think we get this question quite a bit. It's just that people say, oh, where should we start? You're telling us there are all these different cases, a lot of these things that people can do now. Is where do we start? How do we assess which one is the best solution, right? Is sort of the best input-output ratio, cost benefit, etc. Not easy to answer. It depends on your particular situation, I guess. So there probably not a general answer for this. I would think depending on your particular market, your particular expertise, and the technical skill that you can acquire, I think this all contribute to the answer. So there is a customized answer. So we often say when we see questions like this, you really need to maybe find the right people, hire consultants to get a specific answer. So there are probably not cookie cutter approaches that everybody can leverage. That said, I think we do want to produce this volume that describes all these technologies, right, from a top-down perspective. These are the main developments in machine learning, in big data, in other areas of AI, the 3 types of applications we talked about. We want to talk about from a technology perspective, each of the areas, what are the main developments and how are these main developments leveraged? And hopefully that will give people a better sense of the cost benefit. We try to do that in this report, right? In this report, all the cases have 4 or 5 sections, and the sections are basically, one is what kind of background of the firm that we start with, right? And then is the important function is one is how do these things actually enhance the investment process? What investment process are being enhanced, right? And 2 is what technologies are being used. And 3, what's the team structure and the development process? And all these should give you a sense of that cost-benefit analysis, or that's our attempt to address that question in specifically. And then the last one is key takeaways, so you can get sort of their insights. That I think these insights are all very interesting if you're really getting into this. So I guess without having a specific answer for everyone, because it's impossible, but I think this is how you look at it, is how much change you can actually bring to the investment process, meaning the benefit, right? And 2 is how much do you need to put into this? You know, do you have the technology expertise? Can you put them together and work together to get results? So I think those are the things that you would want to look at to start getting some answers. With that, I think we are just over our 1 hour limit a little bit. If there are no immediate questions, I think we'll probably close the online questions. And if you want to raise your hand and ask a question, if not, I think do please feel free to reach out to us with questions later, and we're always happy to connect with our CFA charter holders and investment professionals. Many thanks for joining the session today. Anna, back to you.
Thank you so much, Larry. As usual, it was a very exciting and good presentations. Thank you so much for the attention of all the audience. Thank you for very good questions. And we want to wish Larry to have even more good and excellent reports and researches on the IE and the FinTech as well.